Happy Saturday. We're here to talk again about money. We don't specifically talk about money. What we're going to talk about is what affects the cost of money, what affects the cost of goods and services. Now, for me, I like boar's head smoked turkey. And last year, it was somewhere around $10.99 a pound. And then at some point, it went to $13.50, and I was okay with that. I just hide it from my kids. Now it went to $16.50 a pound. Why? What happened?
That pig is more expensive.
Yeah, I mean that's decent T-bone steak prices, isn't it? So we're going to be talking about what happened in 2022 and what we can potentially expect in 2023. We all have different opinions on it. We're going to kind of merge these together and see what we come up with. So if we go back to the beginning of 2021, or let's say 2020, because what's on everybody's mind was gas prices started to rise in 2020. It coincided with the election of Joe Biden. If you look at the charts, if you look at any graph, you'll see right after he was elected in November, the prices went from, in 2019, we're at $230. Let's see, 2020, we're at $263. Then it dropped to $242, and then 2022 we're at $341. And so gas prices started rising, and then we had the invasion of Ukraine from Russia. And that really put a shock to supply of gas, oil, and commodities, and wheat specifically. And we saw countries starting to hoard wheat. Specifically, it was, which country was it? China was planning to buy massive amounts of wheat. Pakistan was the one who was hoarding wheat. And on top of that, to exacerbate the problem even more, guys, is that there was a drought going on. And the drought drove the cost of all these commodities, wheat and stuff, way up higher than they should be. And then the war, of course, which Ukraine and Russia control about a third of the world's grain, caused this. And then we're left sitting here with, after COVID, after all the money that was spent from COVID and before COVID and the easy money policy from the Fed and Powell, we're left with really high inflation, and that's the problem we're going to be dealing with in 2023. But still, how do we get here in 2022?
Well, you started off with a great point, and you said as soon as Biden took office, that really affected gas prices. Well, if you remember the Keystone XL, the pipeline, on his first day of office, he shut that down. So I'm wondering if that had an effect on the prices, because you said day one.
Remember, we went through the pandemic, and a lot of the economy shut down. Mm-hmm. And then as things started moving back up, prices started moving back up. And gas prices are not all demand and supply fixed. OPEC has a lot of say, and they can control the supply. And so if they cut back on the amount of oil that they want to ship, that pushes the price up.
Well, do you remember the supply? There was those tankers that were sitting off the coast, and people were paying for you to hold the oil, right?
Well, that was a while back.
Yeah. But Mike, I agree with you. However, everybody knew when he was elected that his big push, like he did with the Inflation Reduction Act, green energy was one of his tenets that he ran on. And shutting down the supply of decreasing oil production was part of his thing. And so that exacerbated the problem with prices. And then the other thing is refineries. We don't have as many refineries as we used to have. So getting that to market just drove the price up.
Why is that? Why don't we have as many?
We just don't build any more refineries.
Is there a reason?
Because what we're seeing is peak oil. And oil consumption over the next years is going to decrease. The highest per capita oil consumption in the U.S. happened in 1972.
What were you driving back in 1972? What kind of car did you have?
1972, I had a Camaro.
8 miles to the gallon?
No.
On the highway.
It was efficient.
That had a 350.
Efficient.
That had a 350.
I was getting over 10. I mean, when the government began to talk about 25 miles to the gallon, that seemed like almost pie in the sky back then.
I don't think we've seen peak oil, though, Mike. I disagree with you on that. I think oil is going to continue. I think that there's so many issues with getting all the green energy up to be able to produce the amount of energy that we need, because as we've talked about before, just in Seattle, that study from Seattle City Light said with all the new energy for the ports for the electric cars is going to require 10 times the amount of energy. It's going to be tough to produce that energy with solar and wind.
So if you look at the statistics, solar's was growing prior to the invasion of Iraq, but not Iraq.
Ukraine.
Different war.
Prior to the invasion of the Ukraine, solar was growing at 30% a year. That means that it doubles. In such a fashion, it's exponential. If it continued to grow at 30% a year, in 18 years, solar energy would supply all the electricity that we need, complete for the world. So, I mean, gasoline is the number one product out of oil. And as we convert to electric vehicles, and it's not a matter if, it's a matter as we convert. I can remember doing a radio program in 2016 on the fact that Mary Barra of General Motors and the head of OPEC that same week came out and said they weren't worried about electric vehicles because by 2040 they were predicting 1 billion cars would be sold and less than 1% would be electric.
Wow.
No, I don't disagree with you. I think we're definitely moving towards electric. I just don't see that we're building the infrastructure to get off of coal and oil as fast as
Well, we're
we
not.
want to.
I mean, I'm looking across the street right now from our studio, and I see a gas station, and I don't see a charging port next to it. And until that changes, until every single gas station has some sort of charger, I mean, it's going to be impossible to make the switch. I mean, how are you going to charge your car? I mean, Mike, you have one. You know,
I have one.
Yeah. But you don't go on many. Yeah, you went on one road trip to Bend, right?
Yes.
Yeah. Talk to us about that?
I mean, the charge stations, when I first got the Tesla back almost 8 years ago, there was a charge station in Chehalis that had 4 charging stations. When I went this time, there must have been 25 charging stations all in the same location. And they're set up so that you can charge your car in 20 to 30 minutes and a place to go. But when I went Seattle to Chehalis, charged in Chehalis, charged again in Troutdale. And in Troutdale, there was a charging station. They were set up at Fred Meyer. And there were charging stations. The Tesla charging stations are charging at 440 volts. Electricity goes in, it's amps times volts equal the power. 440 volts gives you a charge in 20 to 30 minutes. There were new chargers that were set up there that I checked out that charged 3 times faster than that. And that's the new charging stations, the supercharger. I'm trying to remember the name of the company that's ChargePoint or something like that, is putting in these chargers. And they started way back in 2005 or whatever, 2007. So it's not something that's happened new. But their charge stations are charging at the same speed as you can fill up your car.
Now, they are lithium-ion batteries, correct?
They are.
Yeah. And so what I've read, and I'm no expert, but what I've read is these fast chargers actually end up damaging the battery and bringing down the life expectancy of that total battery when you're doing those fast charges. And so my question is, over time, how
my grandchild has a Nissan Leaf, and for the Nissan Leaf, for the type of battery that they have, if you charge with a fast charger, it will destroy the battery. For the Tesla battery, it's not true. You get 8 or more years out of the battery. So
that being said, we're getting a little bit off track. Here, guys. Let's focus on how did we get to the end of 2022 and where are we going, right? What happened? What got us to inflation problems? And is it going to keep going? Are we going to keep dealing with that in 2023?
So talking about 2022, it's not just a question of gas and oil. We had a supply chain problem. Coming out of COVID, supply chain problem where supply chains are all over the world.
And China still has their lockdown now, right? They're still locking down when they're protesting now. Right? We said protest in Iran, and I don't want to get into Iran yet, but China. But it's caused because people aren't going back to work, and most of our stuff that we depend on was built there, and we can't get it.
So one of my favorite stories about supply chain is when Boeing is building a 737. You know what the most critical part is?
You told me that the door in the bathroom or something,
Yeah.
right?
The little piece that says vacant or occupied, because it has to be in the language of.
Right.
And
That's right.
so you get that little piece that has to be then sent to a different country to make the latch, and that has to be sent to a different country to make the door, and that has to be sent. The door has to be sent to the place where the lavatory is made, and then the lavatory has to be sent to the fuselage.
Here's another one, Mike. Is that I was talking to a guy that I play basketball with. He does in medical sales. And we started talking about how's business. He runs all the hospitals from here to Alaska for, I forget the medical company. We'll finish this when we come back.
Okay.
About money with your AFC team, Mike, Chris, and Al on AM 1300 The Answer. For more information, click on adamsfinancialconcepts.com.
So I was saying before the break that we were talking about the supply chain, and Mike was talking about his Boeing story with the little vacant or which language the bathroom sign can be in. And the guy I was talking to, as I was saying, he's in medical sales, and he was telling me the other day that they're having the same problem. They're calling their competitors. They're in the operating room and saying, hey, who has a stint? Oh, I better call my competitor and see if I can find the stint. This guy's on the table. We need to get the operation going. I said, really? I couldn't believe it. He said, oh, yeah. He said, we're scrambling to find, because of the supply chain, it's causing us a huge headache. This is a major medical supplier
Yeah.
of critical medical devices that are going into people's bodies.
No, it's supply chain problems have been a real issue in 2022, 2021 into 2022, and were a real function of, or real cause of a lot of the inflation. And I think that's why the Fed and a lot of government people economists felt, that the inflation we were seeing was temporary.
Right. Remember that? That was in the beginning of the year, Mike? Was it? It was transitory?
Transitory.
We've looked at this, right, till the three of us till we're blue in the face. Have we ever seen transitory inflation where it just dissipated in a short amount of time? 70s it didn't. Times before that, and it hasn't. It's always been sticky.
And it's sticky now
Yes.
as we go into 2023.
Yep.
And as we need to talk about it, we need to talk about 2023 and where we're going and what's happening with inflation and what Powell said, what the focus of the Fed has been.
Well, we just listened to that the other day, right? What's his big focus is on the labor market. We're still 4 million shortage of jobs. There's 1.7 positions for every person looking for a job.
Yeah.
One thing with COVID did is that when the market peaked in 2021 of last year, right, November, the market peaked. A lot of people that were 55 and older said, I'm done, I'm out. And so we have this huge shortage of people of labor. Right now.
It's funny because if you log on to LinkedIn and you look at recent posts, you would get the total. It doesn't seem like there's a shortage at all. People are getting fired left and right. I mean, if you look, Twitter's fired people, Carvana, Roku, Amazon's fired 10,000 people, Walmart's firing. I mean, the list goes on. And in the last 2 months, we've seen, what was this? It was more firings in the last 2 months than we had seen in the last 2 years combined.
I read the statistics last month. It was 56,000 people fired out of tech companies.
Yeah.
And that was before Elon Musk got going with Twitter.
You're fired and you're fired.
As we said the other day when we were talking, but TikTok is hiring.
Yeah.
TikTok is hiring like crazy. So all these people that were laid off now, hey, TikTok's hiring.
So, I mean, 1.7 openings for every person seeking a job.
But is this just a change in the labor, right? We looked at some of these companies were coming bloated. Google was paying people, I think it was like 60-something% more than the average Microsoft person. And these people are hiring like crazy. So they just become, is this really are they firing people, or is it just so that they just got too big and they realized that they were bloated and need to cut some dead weight?
Well, I think they were bloated from the pandemic. I mean, there was hiring sprees throughout that period because everyone was remote and it was easy to hire. And I think we're starting to revert back to the mean.
I think so too.
Yeah.
I think companies had the vision that they were going to continue to grow at 30 or 50 or 70% per year. Mm-hmm. And reality set in. And what we've seen during the earnings calls is companies saying it doesn't look as good as we thought it was going to be. Mm-hmm. And still, they're setting record levels for revenues, record for earnings, but it's not looking like they're going to continue to grow at the same rate that they grew in 2021 and so on. So gearing up with the number of people that they're gearing up, they're beginning to lay those people off, or in some instances, freezing hiring.
Mm-hmm.
But when you look at it, normally during a time in which the Fed is raising rates and trying to slow down the economy, you're trying to force layoffs, you're trying to force labor rates down, and you're trying to force unemployment up.
So unemployment's at 3.7% right now.
Right.
What do you think is a healthy number? Obviously 3.7's a good, right? But how high do you think unemployment can go while still balancing out?
Didn't they say 4.4? They thought 4.4
Yeah.
was a good number. What is the labor participation rate right now? What is that at? Because we know that unemployment doesn't tell us the whole story. So how many people are actually looking for a job? Or that? What do you know? What that?
It's around 61 or 62%.
Okay.
But remember, that number includes people who are retired. That includes everybody over the age of 18, and you have several million kids that are in college. I can remember being at a conference and somebody saying the unemployment rates of 5 or 6 or 7%, whatever it was at that time, are really wrong.
Mm-hmm.
Because when you look at it, 38% of the people are unemployed. Yeah.
Yeah.
But, there's people that were in their 90s and their 80s that are retired, and they're part of that. But I think that the Fed is right. There's 4 million people short of filling the jobs that need to be filled.
So here's a question I'll throw at you guys. Right now, 2/3 of GDP is consumer spending. The consumer's holding up the economy right now.
Mm-hmm.
We saw fantastic numbers for Black Friday. The numbers looked good. People went out and spent money. However, one story from Best Buy we talked about is that they saw more people using credit cards, majority credit cards over debit cards, which means they're going to delay the payment. Now, is that a sign of I'm confident I can pay that and the 16% interest, or is it what's another $5,000 on the credit card going to do? I don't care because I've already got $10,000 on the credit card.
Or maybe they're more financially literate now. They're using their credit card and understanding that's a better way to go than using your debit. I mean, that's just, being a little optimistic, but.
So, for sure. And there's a lot of people that are paying off their credit cards. I have only one debit card, and almost everything I have is a credit card.
Mm-hmm.
And I pay that off every month. I would bet that Warren Buffett pays his off every month. He's got a credit score that's a lot worse than mine, because I'm sure that if he takes a trip and charters his private plane, which he does have private planes, those things will run $10,000 an hour some. When you do a 5-hour trip, that's $50,000. Put that on your credit card. You may pay that credit card off at the end of the month, but on your credit report, it shows up as you have $50,000 worth of credit. And Buffett, I would imagine, probably has 6 figures of credit. Whatever it is,
mm-hmm.
His credit score is worse than mine.
So you don't think he's good for it?
Sell a little Occidental Petroleum to pay off the credit card?
So, I mean, it's hard to know.
It is. It is till you see the credit numbers, right? Till January comes around, look at the credit numbers and look at all the money that was spent on the holidays and say, oh, look, the percentage that's on credit and they're only paying minimum payments and not paying it off. And then we'll really have an idea of how strapped the consumer is going to be. But we did notice the savings rate is taking a huge dip.
Yeah, but part of that is because during the pandemic, everybody got a lot of checks.
No, I'm right.
Oh,
right.
yeah.
Right.
They were
flush.
People were flush with cash.
And they were on Robinhood buying Maymay stocks. Chris loves the Maymay stocks.
Yeah. The meme stocks.
The memes.
The memes.
And then who is it that's still shorting in the GameStop? Carl Icahn said, nope, I'm not giving up my short on I'm shorting the heck out of that stock.
So,
but it's interesting. It's interesting.
So where are we going to be in 2023? Because we're seeing we're seeing the consumer price index come down. But that's not what the Fed is looking at.
No.
The Fed is looking at the PCE, the Personal Consumption Index.
Yep.
And
Can you explain what that is, Mike, so everybody knows what the PCE is?
yeah, so the PCE is a different basket of stocks.
Doesn't it? Can you break? Do you have the percentages to break it?
I don't
You
have the percentages.
Okay.
It's more inclusive and it's more accurate as to what's really going on.
Mm-hmm.
I mean, the problem with the Consumer Price Index or Producer Price Index can best be illustrated maybe by saying the cost of light. If you compare a candle, the cost of a candle versus an electric light bulb versus a tungsten versus, as you go up, the LED lights, looking at just the price of the unit, the price is not increasing that much. But think about the lumens that are generated by the LED compared to the candle.
Mm-hmm.
It's what, 5,000-fold? And yet the price hasn't risen 5,000-fold, So the problem with the Consumer Price Index is it only counts the unit price of things increasing.
Right.
So the Personal Consumption Index is an attempt to get more accurate, real pricing in terms of what people are consuming.
Right.
And I think it's important to note that it does exclude both food and energy, which
Yeah.
tend to be the most volatile.
Well, the one that the Fed is looking at,
Mm-hmm. Mm-hmm.
Because those are really volatile. And that's something that happened during the 60s and 70s is people quit looking at the food and energy, especially with what was going on with oil prices.
So, getting back to that, Mike. Well, the Fed kind of alluded to either another 75 or 50 basis point hikes. Do you think they'll stick with 50, or think they'll do one more 75 here in December?
I think Powell will do 50.
You think?
My guess, he said during the conference that it wasn't the amount. It's not how much they raise each time, but it's where they get to.
Right, right.
We're coming to a commercial break. We'll come back and talk about that concept because I think that makes a lot of sense for understanding inflation.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike, Chris, and Al.
So we were talking about the Fed and raising interest rates, 50 points or 75 basis points. I don't think it makes a lot of difference. I think that there was some indication they might do 50 basis points. But the real question is, where do they get to? And I think that's what Powell alluded to. There's a principle called the Taylor principle that says if you want to reduce inflation, you have to have an interest rate that is higher than the rate of inflation. The Taylor principle is an economist, I think his name was James Taylor. Or maybe that was the singer. I don't know.
Fire and Rain?
But the idea is you have to have an interest rate that's higher than the rate of inflation. And I think that's what Powell was indicating, is the PCE has been basically steady for 2022 at 5%.
I thought it was 6.
5.
Okay.
And so if they're going to control inflation, that means, according to the Taylor principle, they need to be above 5. They need to be at the 6 that you mentioned, Chris, to control the rate of to get inflation down. And once they begin to see the PCE, ex food and energy, come down below the 5 and begin to really drop, and they feel that that's significantly happening, then they can begin to lower interest rates. But if you remember what he had to say, there's 3 components of the PCE. There's the core goods that make up a portion of it. There's the housing services, which includes rent, and everything besides core and housing. Everything else is 50% or more than 50%, which I thought was interesting. In the core goods, they'd seen a drop from 7.5% to 4.5%. So that portion is dropping. Housing, on the other hand, has been running up. And when you think about it, when interest rates go up, housing is really interest rate sensitive. Housing, mortgages go up, housing prices go up. I mean, actually, housing prices tend to go down when you reduce the demand, but mortgages go up, rents go up. So that one is increasing. But it's really the cost of the other more than 50%. And that's where the number of people that you mentioned, Al, 4 million people. And the other items are driven a lot by wages that are being paid.
And that's what he said yesterday. His target is the labor market. Till he gets the labor market and see some softening there, he doesn't feel like we're going to be out of the woods with this yet. And it might take till the end of the year, and it could take into 2024 to see that soften.
I'm not sure we'll see it soften for more than a decade. Think about 4 million people are short. Already, they say that 2 million are due to people that lost jobs, the COVID, increases in wealth, people that withdrew from the labor force. But 1.5 million are because we're seeing a slower growth in population. I would not expect that to change.
No. As we talked about population, we're at 1.4 children per person. And we need to be at 2.6 to replace the population. Complain about immigration all you want, but immigration is going to have to save the day. And we need to have a system of bringing people in that want to work and join the workforce.
The issue on that is that other countries are really focusing on not losing their most educated and most qualified people. And with what's happening with the internet, they don't have to come to the United States. The world has become flat. The world, you can do the same thing, and software developers are being used in the Ukraine.
I still think if you're in the Ukraine or one of those countries, you don't want to come here.
You do, but what we're not talking about enough is people not wanting to work. I mean, the unemployment benefits ended at the end of August after extending for over a year, right? On average, people were making they were making about $42,000 a year. If you average it out, it was about $900 a week. Well, if you're paying someone $900 a week to sit at home on the couch, play video games, do whatever they want to do, hang out with their family, why would they work, right? And so I think a lot of that 4 million that we keep mentioning, a lot of that is due to people simply not wanting to work and being incentivized to stay at home. I mean, I know I'm not gonna name their names, but I know a handful of people that fit that bill. They just don't want to work, and it's like, why would they if they were going to make the same, if not maybe even a little more, by just staying at home?
But those benefits ran out.
They did, but that was only a couple of months ago, and so I think I think we need a full year for that to recover before we get a more accurate depiction of, the labor force.
I've seen studies that say that's not really a factor. But we'll see. We'll see if you're right.
I mean, I talk to them. They don't want to work, and these are educated individuals that went to private school. I mean, they have college degrees, a lot of them, and they like a free paycheck for not doing anything.
And it's probably better than working at Starbucks as a barista.
So let's switch gears and look at what people are predicting for 2023. Everything I read is gloom and doom. Leon Cooperman, hedge fund and billionaire investor, saying that the S&P 500 is going to be flat for the next 10 years.
I like the doom and gloomers. Let me find an article. I'm looking right now. Say something while I look my article
So
up.
he says, expects the S&P 500 eke out a mediocre return for the rest of the decade. He predicts U.S. recession, stubbornly high inflation. What else?
Doesn't John Templeton say that bull markets are born on pessimism?
They are.
So isn't all the gloom and doom, isn't that a good thing?
They mature on optimism. So think about Harry Dent. Harry Dent wrote a book called
Harry Dent. I read his book.
Dow 36,000. And he expected that by 2000.
Yeah.
Okay.
Yeah, I remember that. I remember those days.
And then he wrote the book, Crisis Investing. Surviving the Great Depression. Oh, maybe these maybe these weren't Dent. These were some other books. Surviving the Great Depression of 1990. The Collapse of the Dollar and How to Profit from It, written in 2008. So, I mean, Dent said, Dow Jones was going to hit 35,000. It didn't hit. And then he went on to predict that things were going to go down. In the 1980s, when I got into the business, I licensed. One of the big gurus was Proctor, Robert Proctor, the Elliott wave theory. And he'd been correct. I mean, during the period of 1966 to 1982, he was correct, in predicting that the market was going to drop. He came out and predicted that the market was going to drop in 82, and it didn't predict. So that raised some questions. But in July 2010, when the Dow was at 9,686, he comes out with his prediction the Dow's going to go to 1,000. 1,000.
By when? What was the date he put on it that it would go to?
Over 5 or 6 years.
Oh, okay.
So that means by 2015 or 2016, Dow 1,000. When you look at the companies in the Dow, to think about their stock prices sinking 90%. Anyway.
Well, Goldman Sachs chief U.S. equity strategist expects a soft landing with the U.S. economy growing about 1% next year.
Yeah. I mean, Alan Greenspan predicting that Greece was going to completely default in 2010 and 11 without a dramatic change of heart. It was going to drive Greece to bankruptcy. Peter Schiff. I saw Peter Schiff. I went to one of his seminars. And when he was predicting that gold was going to hit $5,000 an ounce, $5,000 an ounce, that was in 2011. It did get to 1,900 in 2011. And that's when he came out with 5,000. 5,000. Dead wrong. He also then said the dollar is going to collapse. The dollar is going to be worthless. And commodities are going to be worthless. So how do you survive? Well, sign up and become one of my clients. And I'm in a room of high net worth people, all accredited investors. And they're sitting there, and I would bet that a third signed his little thing. I mean, his whole presentation in over an hour was doom and gloom and everything's terrible. Doom and gloomers have this thing that if they can scare people and say, I have the solution. If you follow what I say, just follow what I have to say.
That's when I started in the business. That was the tagline of the company. It was right during 2008. The market's never going to return 8 or 9% again. Get out and put your money here, and you won't lose anything, right? You won't lose anything except your purchasing power because it's not going to grow that fast. But that was their tagline, and they made a heck of a lot of money doing it.
But that's what sells. Negativity sells.
It does. Mark Faber, Dr. Doom, predicted hyperinflation of 1,000% a year. I mean, all these people predicting these things, they get the news. There was an article that Bob Various, who is a consultant in our industry, he wrote an article saying, if you really, as a financial advisor, if you really want to pick up clients, you come out and you contact the newspaper, TV stations and say, I'm predicting the market's going to crash. He said, you'll get newsprint, you'll get TV, and it's true.
It is.
We're not predicting that the market's going to crash. Our administrative manager is Sarah. Mm-hmm. And I tell a lot of my stories, and Sarah will say, I wasn't born then. Chris can say that. Because I want to talk about 1987.
I remember 1987.
You do. Chris wasn't born then.
I was still with my dad, yeah.
It was a cold day in Boston that Monday.
So the market had the most dramatic drop it's ever had. And there was a guy that came into our office, a mutual fund wholesaler, who said, you're going to be walking to Nordstrom this week and hear a pin drop. $1 trillion has been removed from the economy. It's going to be a disaster. I told my wife, we got to go to Nordstrom's this weekend. We couldn't get into the store. I kept saying, people must not have told the people in here they've lost $1 trillion. But the other thing that happened is I began to count the number of people who said things were going to get worse and the number of people who said they were going to get better. At 68-0, I quit counting. Those were newspaper articles, TV, all the people. They were saying this is truly a disaster. So when you talk about people being doom and gloomers, you get more publicity by being a doom and gloomer than being optimistic.
Mm-hmm.
There were people in 2008 who were negative. Smead Mutual Funds, he called CNBC. They were asking, is there anybody who's positive? He called and he said, we're positive. That's how he built a $1 billion
Yeah.
mutual fund,
Yep.
is because he was the only one that was positive. Everyone else was negative. So as we're going through this time, we're going to hear a lot of negative things.
No, it's like I saw an interview on Bloomberg with the CEO of Snap-on Tools. I think I told you guys. He was really positive. He's like, man, these mechanics, these shops, they can't find people fast enough. They can't hire them fast enough. We're selling tools like crazy. Our growth is this. He said, I don't see. I think, he believed that that he thinks that this is, it could be a really good year. So he was really positive.
Well, I hope, because, those mechanics are going to be out of work here in a few years when everything's electric, right?
They got to make their money now.
Yeah, they do.
So
They do.
No, I mean, if you talk to businesses, there's certain businesses that are really struggling. Housing is beginning to struggle. But
yep, it's
a
still
lot of
short
business-
supply, though, with housing, Mike. It's still, the mortgage people, I agree with you in some perspective, but there's still short supply and he's not building as fast enough.
But the housing prices nationally are dropping.
Yeah.
So, I mean, you're going to have parts of the economy which are affected in a negative way. But when you listen to the Fed saying there's 4 million people short of filling the jobs that are out there, that means that people are working. When 2008, unemployment was 10%. And everybody was looking over their shoulder to see if, am I the next person fired? People were looking over their shoulder, is my house going to be foreclosed? I mean, it was a time in which it was really a negative period of time.
Well, so wasn't after 2000, 2001, 2002, 2003. Those were tough
Those were tough times.
too.
But not like 2008.
No.
And we've gone, in 1994, we went through that.
Yep. I remember the early
We've
90s were tough.
We've gone through tough times before. But I don't know that we've ever seen a time in which we've seen the Fed raising interest rates to slow down inflation, and you can't fill the number of jobs that are available. So we're entering a really strange time in 2023. We're going to enter a time in which we probably will not get inflation down. Inflation's going to be a persistent problem. And for investors, it's going to be even worse. If you look at the average investment account, I had this week, I had a person that manages $1 billion fund, $1 billion of private money, who, I thought it was funny, they said that 97% of their clients were satisfied, and they're averaging a 2% per year return. 2%. People just took a negative 6% or 5% or whatever it is, 3% in terms of purchasing power to have a 2% plus return. So the average financial advisor, the financial planning people are producing on the average a 5% return. Number of studies that have shown that 5% means if we have a 5% PCE, they're just maintaining purchasing power. There's no growth. And for the people that are trying to increase their income, they're dead flat. And 5% is what we've seen during the past year. If we see a pickup in inflation, and it's very possible in my opinion, to see that, that means they're in worse shape. They're going to be losing value. If you look at the 1960s and 1970s, inflation averaged 6.8% compounded. That's above what we're seeing today. And it wasn't every year because we know that the curve continued to increase for a period of time. But if we see that kind of increase, that puts investors at a really disadvantage unless they can do something over and above that. And you looked at that, Chris.
Mm-hmm. Well, right now, 0 doesn't even look bad. Really looking at, but yeah.
It's being in the right places and the right stocks to counteract the improvement or the increase in inflation. And we've talked about that on the radio before. During the 60s and 70s, there were stocks that did very well, even though the stock market didn't do well.
Mm-hmm. The Nifty 50, the companies that rose from the ashes, the McDonald's, the Sears, the Procter & Gamble's. So, I mean, yeah, there were staples that came out of that inflationary time, but you got to wonder, where are those today? Have they even started? Have those companies begun? Have they been founded? Or
some of them have been.
Yeah.
But
as you know, things that have never happened before happen all the time, right?
They do.
So who's to say that, at a time where, the Googles and the Amazons are bigger than they've ever been, who's to say that maybe they keep the train rolling? They get even bigger than they currently are.
Or maybe they're some of those that have reached the peak and are headed down the other way. I mean, Richard Foster did his study. We've talked about that. Mm-hmm. Richard Foster of Yale showed that the average life of a company in the Standard & Poor's in 1920 was 70 years. Today it's 15. And maybe these companies that are so big may have reached their peak.
Maybe some of them. I think some of them are still investing heavily into the future and technology too. We talked a little bit about the quantum computing, and these companies are knee deep in research trying to get the first quantum computer up and going. And so I think there's room for them.
We'll see. I mean, there's certain companies that will come out of this on the plus side. Mm-hmm. Certain companies will never make it. It's picking the right ones, being in the right place at the right time. And some will be mistakes. That happens too.
Can't be right all the time.
Anyway, 2023, where do things stand? I've been around for 36 years. I think 2023 is going to be a difficult time. I think it's going to be a stock picker's market. There's going to be those companies that do well in 2023 and those companies that really do poorly. I believe that index funds will probably have an issue. But being in the right place at the right time is the right thing to do. That wraps us up for this week. Have a very wonderful weekend. And next Saturday, we'll be back to talk about money.
You've been listening to About Money with registered investment advisors Mike Adams, Chris Yand, and Al Souza. If you'd like more information about what you've heard today, or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.